Here's something that sounds impossible. A startup raises $50 million. It goes public. Headlines call it a massive success. And the founder who built the whole thing walks away with less than $1 million. How? One word: dilution. Almost nobody explains it properly. In this video, we'll follow two fictional founders, Alex and Sam, through the real journey a startup takes. Every funding stage, how their company's value gets decided, and what happens the day it finally goes public. Meet Alex and Sam. They just built an app and own 100% of it, 50% each. Now they need money to grow it. They have two options: debt, borrow money, pay it back with interest, like a car loan. You keep full ownership, but you owe it no matter what. Equity, sell a piece of the company. An investor gives you cash today for a percentage of tomorrow. No monthly payments, but you own a little less every time you do it. That shrinking ownership has a name: dilution. It's the main idea of this whole video. Alex and Sam choose equity, like most startups do. It happens in stages called funding rounds. Let's follow them up the staircase. Each step up means more money raised, more growth expected, and more ownership given away. Day 1. An idea and a rough app. Barely any users yet. Money comes from the founders themselves, family, friends, or an early angel investor. Typical raise: $250,000 to $2 million. Ownership given up: 10 to 15%. Alex and Sam started at 100% between them. Now they're at about 85. Doesn't feel like much yet, but every round compounds on this one. Investors here usually get a safe note, a promise that their money converts into real shares at a discount once a proper funding round happens. Keeps things simple when there's not much to value yet. The app is working. Real users, a little revenue. Time for their first real investor, a seed-stage VC firm. Typical raise, around $4 million. Ownership given up, about 20%. Here's a term you'll hear constantly: pre-money valuation. What the company is worth before new money arrives. Simple math. Investors value the company at $10 million. The investor puts in $2 million. Total value is now $12 million. The investor owns $2 million of $12 million, about 17%. Alex and Sam now hold the other 83 between them. This is also where most startups die. Carta, which tracks over 40,000 startups, finds only 15 to 24% of seed-funded companies ever raise again. Alex and Sam are about to find out if they're the exception. They made it. Revenue is growing every month. Now it's time for a real venture capital firm, the kind that funds names like Sequoia or Andreessen Horowitz. Typical raise: $10 to $15 million. Ownership given up: another 18 to 20%. Investors here usually want $1 to $4 million in annual revenue before writing a check. They want proof, not just an idea. Here's the part that catches first-time founders off guard: the employee option pool. Investors require 10 to 15% of shares set aside for future hires. That pool is created before the investment is priced, which means it dilutes Alex and Sam, not the new investor. Nobody warns founders about this in advance. After Series A, Alex and Sam together own roughly 36 to 42%. Series B is about scaling what already works. New cities, more hiring. Typical raise: $35 to $40 million. Another 15 to 18% gone. Investors here are larger VC and growth equity funds paying for proven growth. Alex and Sam are now down to about 27% combined. Series C comes right before the big exit, an IPO or acquisition. Rounds run $50 to $100 million or more, sometimes far higher. Another 12 to 15% given up. Private equity firms and hedge funds start showing up alongside the VCs. By now, Alex and Sam own just 15 to 22% of the company they built from nothing, according to Carta. Every round bought growth. It also cost control. At every single round, one question sat at the center. What is this company actually worth? Honest answer, there's no official formula. No government sets it. It's whatever a willing investor and willing founder agree on. But the agreement isn't random. Early on, it's judgment. With no revenue to analyze, investors weigh three things: the team's experience, the size of the market being targeted, and what similar startups raised at recently. If 5 comparable seed deals priced around $8 million, that becomes the anchor. Later, it's math. Once there's real revenue, investors use a formula. Valuation equals revenue times a multiple. A company earning $5 million a year and a market valuing similar companies at 10 times revenue is worth $50 million. That multiple comes from public markets, what similar listed companies trade at, discounted a bit because private shares are harder to sell. Fast growth and high margins push it up. Slow growth and heavy losses pull it down. And the multiple moves with the economy. In 2021, near zero interest rates pushed software multiples to 20 to 30 times revenue. By 2023, higher rates drag that down to 5 to 8 times. Same company, same revenue, worth a third as much, purely because of the economic climate. After all those rounds, Alex and Sam's company is ready for the big one, the IPO, Initial Public Offering. This is when the company sells shares to the public for the first time. Why do it? Raise a huge amount of capital at once, give early investors and employees a way to finally cash out, and gain the credibility of being a public company. Step 1. Hire a bank. An investment bank runs the process for a fee, typically 7% of what's raised. On a $500 million IPO, that's $35 million straight to the bank. Step 2. File with the SEC. The company submits an S-1, a full disclosure of its finances, risks, and plans. Review takes 45 to 90 days. Total process, start to finish, 6 to 18 months. Step 3. The roadshow. The CEO and CFO spend about 2 weeks pitching big institutional investors, pension funds, mutual funds, to gauge demand and set a price range. Step 4. Pricing. The night before trading, the final price is set, the number Alex and Sam have waited years for. Companies almost always price a little low on purpose to guarantee a first-day jump. University of Florida research shows IPOs rose an average of 21% on day one between 2000 and 2020. Exciting, but it also means money left on the table. Step 5. Lockup. Once trading starts, insiders, including Alex and Sam, can't sell yet. A mandatory 180-day wait prevents a flood of selling from crashing the price. So even now, on the day the world calls them a success, they can't cash out a single share. So after every round and the IPO, what do Alex and Sam actually own? Combined, about 8 to 10%. That's the median for founding teams at IPO, per Carta and Saster. They started owning 100% of nothing. Now here's the reframe. If the company is worth $2 billion, that 10% is $200 million. They gave away almost everything they started with, but built something so much bigger that the small slice they kept is worth more than the whole original pie ever could have been. That's the trade. That's why they said yes at every round, even as their ownership kept shrinking. That's Alex and Sam's journey, kitchen table to opening bell. Every round diluted them a little more. Every round also made the company worth a lot more. That tension is the whole story. Next time you see a headline about a Series B or an IPO, you'll know exactly what's happening behind it. If this helped, subscribe and comment down your doubts. We explain finance like this every week.